Good morning. Welcome to the April 7th, 2022 investment meeting of the Teachers Retirement Board. I'm going to start by calling the roll. Tom Brown.
Good morning, Patricia. I'm here.
Good morning. Russell Buckley.
Present.
Phil Dukes.
Present. I believe Schumann will be doing the question asking today, if there are any questions.
Okay, so Schumann Ray instead of Phil Dukes. Are you present?
Hi, yes, I'm here.
Thank you. Allison Hirsch.
Here, I will have to step out briefly, and while I do, John endorses the DMAT.
David Kazansky.
Present.
Deborah Penny.
Good morning, I'm present.
We have a quorum, so I'll turn it over to Madam Chair.
Okay, good morning, everyone. We're going to start out with Passport Fund's February 2022 performance review. Mr. Fulvio.
Great. Good morning, everyone.
Good morning, Michael.
I'm going to attempt to share my screen to help facilitate that discussion. That actually works. Great. Perfect. So we'll start off with the performance of February for the Passport funds. And at a high level, what will stand out here is, as you'll recall, February was another down month for markets, as we saw both continued concerns around inflation, and then coming into the end of the month of February, the invasion of Ukraine by Russia, and obviously the amount of market volatility that followed with that, showing up in the negative numbers you can see for various parts of the equity markets. So in total, what we call the global market composite, which is a mix here, a benchmark we use for the diversified equity fund. You'll recall it's about 80% US equities. The US equity market was down about 2.5% during the month of February. And then the international composite benchmark, a mix of both developed and emerging markets, we're also down about 2% during the month. The global market composite down about 2.4%, and the diversified equity fund slightly behind that by a few basis points. Year to date, that brought the diversified equity fund's return to negative 8.2%. That was lagging, if you will, the global market composite and hybrid benchmark by about 45 basis points. I should say the contribution or detraction rather in terms of the relative performance came predominantly from the actively managed US strategies, which has been a challenging period for active management in the first couple of months of the year. And then in the international equity composite, again, some relative underperformance from active managers in both February and the overall year-to-date time period. The balanced fund had assets at the end of February of about $575 million. You can see both with the sell-off in equities and fixed income assets year to date, that fund is down about 3.7%. The international equity fund had a return of negative 7.3%. The sustainable equity fund, which you'll recall is more of a growth-oriented strategy and it has a growth-oriented benchmark, that fund was down about 3.9% for the month of February. It outpaced its benchmark, which was down about 4.25%. That fund so far year to date is down about 16%. And then the two index-oriented options down roughly in line with their benchmarks. The US equity index down about 8.4% year to date, and the international equity index down about 5.9% year to date. The story does get a little bit better with respect to market returns for the month of March, but happy to take any questions before we head there if there's anything on February.
Any questions for Mike on February? Okay.
Great. The March report, which I'll also put up on screen. So as I noted, the March numbers, as you can see here, did turn positive. Not enough to turn the calendar year to date positive, but March actually continued, as the month began, it continued much like the end of February, with markets selling off and being quite volatile given the ongoing conflict in Eastern Europe. The benchmarks did turn positive in quite a notable way. The markets rallied, equity markets rallied into the end of the month of March, and you can see finished March with positive returns. So the global market composite I described earlier, that returned positive 2.5, 2.6%. Really where that came from was within US equity markets. You can see the Russell 3000 index was up about 3.25% for the month of March. The calendar year to date, the US equity market was still down about 5.3% through the end of March. The MSCI ACWI ex US IMI index, think of that as all global equities outside of the US, so encompassing both developed and emerging markets. That also had a positive, more modest, but positive return in the month of March to the tune of about 30 basis points. And year to date, that portion of the global market is down 5.6%. So the diversified equity funds hybrid benchmark for the month was up about 2.5%. And we would expect the performance, as we've discussed in the past, of the fund to be somewhat similar to what we've seen there in terms of market returns. The balanced fund benchmark had a negative return of about negative 71 basis points year to date. The calendar year to date return for that benchmark is down about 3.97%. And then, as I noted earlier, international markets with the more modest negative return for the month. You can see the international composite benchmark that was down 6 basis points. Developed markets with a positive return of about 64 basis points, and a negative return for EM when looked at on its own. Emerging markets were down about 2.25% for the month of March. So I'll pause there and see if there's any questions.
Any questions for Mike?
None for me. Just want to get in the record.
Okay, I think we're good, Mike.
Okay.
All right. So now we turn to public agenda for the pension fund, and we have a quarterly fund performance overview.
Dan or Kate, whoever's got the slides, can we bring them up, please?
You all see them on screen?
Yes, we are good. Thank you. And just go to the next slide. So we are proud to share with you our revamped quarterly performance reporting that we're going to do on your behalf, and some notable changes to how we're going to do this. I would say first and foremost, one of the benefits of reporting just to you is we don't have to do any of that comparative stuff. So you're going to hear just about your portfolio.
Must be do better.
No, that's a good thing. And I think the other major change is on a quarterly basis, we're going to give you a deep dive from 2 asset classes every quarter, and we're going to rotate that.
Great.
So today you're going to hear from John Mersberg on public equities and Petra Nikolova on the infrastructure portfolio. So that's going to be, we're going to do that in executive session so they can go into greater detail.
Good.
And then, like before, as requested, we're going to give you a more timely update on your performance, given that what we're about to go through feels like ancient history, but nonetheless, let's move forward. So here are public market returns for Q4. Not going to spend a lot of time on this because you've heard it from Mike, but a couple things to draw your attention to, because I'm going to refer back to it, is the strong performance in the in the 3 months for US equities, the poor performance for international equities, and I'm going to talk about both of those in a little bit. And then the other, the last 4 rows on this chart are your some of your fixed income exposures. And note, long duration had positive returns, while your credit portfolios were barely positive. And that had a function to do with the change in slope of the yield curve. Next slide, please. So some key drivers of market returns in the fourth quarter. A reminder, the Omicron variant really took off in the fourth quarter. In this country, it was December, but prior to here, it started in Johannesburg and quickly it spread to Denmark and England. So the scientists had it right on its impact. So that slowed the whole service sector reopening, which kept long yields lower. And it was a big impact on that. In the US, the inflation data worsened in the fourth quarter, and the market started to price in a little bit of Fed rate hikes in the front end, and that caused the curve to flatten. So 2-year notes were up 35 basis points, while 30-year bonds were down 15 basis points. It's unusual that they go in the opposite direction. They often go the same direction, but different magnitudes, but that's a big change. And that is reflective in the returns in there. Emerging market underperformance, which is in Q4, and as Mike mentioned, still in Q1. A couple different themes here. The central banks in emerging markets started pricing rate hikes, started actually rate hiking earlier due to just the rhythm of what's happening, you know, and I've listed a few of them here, and Brazil was quite active. The second theme was China's pivot in this economic prosperity. And if you recall, the first sector that really got beat up was the private education stocks. And then it spilled over into some of the mega finance and banking stocks. So that hurt the entire Chinese equity market. And so that's a big part of the emerging market equity negative performance. Next slide, please. So your portfolio. So we've listed your asset classes, and then the second column was the NAV at the end of the year. And then a look at 3-month, 1-year, 3-year, 5-year returns. I would go first to your total returns, about 2/3 of the way down, and note for every time glimpse here, your returns were greater than your policy benchmark, which is the second to bottom row on here. So that's a good thing. The other thing we measure you against is index 65-35 portfolio, 65 being equities. And you've underperformed that in the last few time periods, and that's due to you have a heavy weight in emerging market equities, like 9.5%. In this index, there's 0 exposure to emerging market equities, so it's really a difference between your portfolio and the benchmark. Bottom one is the TUX, which is a reminder is 20 billion and larger pensions, endowments, and pools of capital. And as a reminder, also it's gross of fees. Everything we're showing you is net of fees. Underperformance here meaningfully in the 3 and 1 year, and that really is due to their heavy exposure to privates, which we're limited to for obvious reasons, as well as their exposure to venture capital, which has just had a spectacular run. The other thing I would draw your attention to here is the returns in private markets. So private equity, real estate, and infrastructure, and alternative credit, all very strong in the 3 and the 1 year numbers. And that obviously has been accretive to your total performance. And we're going to go into greater detail on that in just a minute. Next slide, please. So when we decompose your returns versus your benchmarks, we break it into 2 subcomponents, asset allocation and manager selection. And you can see the excess return was small, 18 basis points. The allocation effect was a small negative. The selection effect, a small positive. But given the time we spent on manager selection, we're going to go a little deeper into that. Next slide, please. So this is another change in how we're reporting to you. We're going to show you excess performance in public markets. The next slide is excess performance in private markets. In public markets, we're showing you the shortest time frame is 3 months. But in private markets, we're only going to go 1 year and longer, given not a lot changes in private markets quarter to quarter. And we really want to focus on some of the longer term things that are happening in private markets. So in public markets, what stands out here? The second row, World ex-USA, underperformance on the shorter time period, longer, still strong performance on the longer time periods. And John in his deep dive is going to address that for you. In the fourth row, that's your core fixed income. For core fixed income, not a lot of deviation in the shorter time periods. The longer one, the negative excess return, again, that was to our miss on duration on your behalf. So that's still showing up in those numbers. So that's the result of that. The other numbers, I guess the second to bottom row, your ETI portfolio. Remember the duration of your ETI portfolio is longer than the benchmark. So when rates are falling, one expects positive outperformance. When rates are rising, negative. So that's the attribution for that excess performance. So now more interesting. Next slide, please, Dan. On private markets, you see some large outperformance and large underperformance numbers. Again, I'm not going to talk about infrastructure because Petch is going to do that for your behalf. But in private equity, extraordinarily strong returns across all these time series. Starting with the shorter time series, the 1 year, both realizations and markups in your portfolio that you benefited from. And the really strong performers on the 1 year included Apex, KKR, and EQT, all with 1 year returns in excess of 70%, 70. Yeah. And then Platinum was the other star performer, greater than 50%. The 10-year number you see is still negative, and that's a function of your primary versus your runoff managers. And again, it's something like 80-20 primary, but the difference in returns is like 1,200 basis points. So that's still a drag on your longer term performance. In real estate, you see some mixed numbers here. So in the 1 year, the outperformance is due to markups that occurred during the pandemic. They were marked down, now they're marked back up. The second thing that you've benefited from here is your portfolio construction, and that you've had an overweight relative to the index in industrial and an underweight, importantly, to retail and hospitality, which has really suffered in the real estate space. Strong performers included Exeter, KKR, and Blackstone. And your longer term numbers are being hurt by your affordable housing investments. And as a reminder, that's Related and Hudson. And the two factors hurting you there, again, were the change in the rental laws of 19, which hurts your investments. And then the eviction moratorium, it hurts the cash flows. So that has hurt both of those investments. And to share some numbers with you that the team gave me this morning, Related on a 1 year is up 4.5%, but on a 3 year is down 14.4%. Where Hudson, more on the eviction stuff, down 7.4% on the 1 year. On the 3 year, it basically flat. So is what it is. An opportunistic fixed income, strong outperformance. And the 1 year outperformance really came from 4 of your managers who really have a broad mandate. And the sum of those 4 accounted for over 50% of the total returns. And those managers were KKR, Marathon, Apollo, and Oak Hill. Next slide, please. So rebalancing activity on your behalf in the fourth quarter. I think we shared this with you before. But if you remember again, the fourth quarter US equity outperformance, as it continued to rally, we sold into that very slowly, and we took your overweight in global in equities from like 2% closer to 0, as we were concerned about the rising inflation and potential impact on markets. And that resulted in 9 separate transactions and about $2.5 billion out of your US equity portfolio. Again, to get you closer to neutral. Where did that money go? Primarily to the cash desk, and also to some of your underweights, which was in different components of your structured fixed income market. And that's reflective of the sums of these numbers here. Next slide, please. And these are your overweights. And a change here too. I really like the bubble charts, but the bubble charts didn't show a time series. They showed you a point in time. So I thought this would be more instructive to see how your over and underweights have changed over the trailing 3 quarters. And as I alluded to, your cash number went up, and the core fixed income stayed about the same. And importantly, your equity overweights, if you look at the end of June, they were in excess of 2%. At the end of September, about 1.7, and then importantly, at the end of the year, that number had come back down to being barely overweight. So I'm going to turn it over to Dan, who's going to do some risk analytics on the fourth quarter, unless there's any questions or comments on Q4.
Mike, I have a quick question. On the cash doubling, right, from 1% to 2%, in the context of rising inflation, could you just kind of explain a little bit more about the strategy there?
Sure. So long-term allocation to cash is 0.
Right.
So you have to have some cash balance just because of the
For cash flow needs.
Yes.
Sure.
In the rising rate environment, obviously that's bad for fixed income. So we don't want to put the money in fixed income. We're concerned about valuations in the equity market and how rising rates are going to cause PE multiple compression. So we didn't want to put it back. We took it out of the equity market because you're overweight. So we really were left with not a lot of places to put it. recognizing the real return on cash is highly negative given the inflationary environment. It's better than highly negative and minus if we had stuck it into the other asset classes. So it was a last choice, if you will. And in terms of trying to be a little bit defensive in the portfolio, it's the only option.
Thank you.
You know, we put it in private markets, you know, it takes years to deploy and
Understood.
so on and so forth. And they all march to their pacing plan. So thus the decision to go to cash.
Understood.
And again, small under and overweights, really small under and overweights. Over to you, Dan.
Great, thanks, Mike, and good morning, everyone. Again, 2 slides here today, at least in this section, just showing you some highlights from the risk summary report that appears on your quarterlies. We'll jump right in here. If we look at the top left panel, you'll note the total plan risk for the quarter ended December 31st was 10.59%, which is down from 11.3% in September. Your benchmark risk also fell. It's currently at 10.33%, which was down from 10.84% in September. The portfolio risk declined a little bit more than the benchmark risk over the quarter, and you see small corresponding reductions in active risk and beta quarter over quarter. As we look at the bottom panel, just kind of moving around the slide there, we plot, as before, the ex-ante portfolio risk, that's the blue line, the benchmark risk, the red line, and beta. So portfolio beta is the gray bars there, for each of the last 12 months ending in December. Notice here that the projected portfolio benchmark risk continued the downward trends that we would have seen in quarters past. Moving to the top right, that chart breaks down the change in risk during the fourth quarter into 3 broad categories. There's a change in volatility, the change in correlations, and then the change in portfolio exposures. Those top 2 categories, the change in volatility and the change in correlations, are market-driven phenomena, meaning that the risks decline in step with market risks and were not the result of specific portfolio weights or tilts within there, within your investments. The change in portfolio exposures, that third line there, represents a portion of the portfolio risk that was detached from these other market trends. Here, the 29 basis point reduction in risk was led by U.S. and Eurozone equity market factors. And then the last section there, the asset class contribution to risk in the top center. This table shows you the differences between the portfolio allocation by assets and your allocation to risk. As in quarters past, you'll note that we've allocated about 60% of the portfolio to equities. The standalone risk coming from the equity portion of the portfolio is 16.71%. And the standalone risk coming from the fixed income investments is 2.94%. On a contributory basis, we see that 10.13%, that's the next column over, or about 96% of the total risk is coming from equities. And we'll elaborate on that theme on the next slide here, where we're showing you the portfolio allocations, performance, and then risk broken down by strategy as of December 31st last year. If we look at the leftmost section, we'll take the allocation first. We see a snapshot of your marketplace adjusted allocations as of December 31st. This is echoing some of the slides that Mike showed you a few minutes ago. At that time, again, we had slight overweights to cash and we're underweight core fixed income strategies. The performance section in the center shows you a 1-year return by strategy relative to the benchmarks. Here we see the alternatives outperforming their benchmarks, and we show an underperforming developed markets equity. And again, John will be breaking that down for you in a little more detail in a few minutes. Next, we decompose the risk by strategy in the rightmost section. The first 3 columns in that section show you the portfolio risk, the benchmark risk, and active risk or tracking error for each strategy. By way of reminder, tracking error is an indication of how closely the portfolio follows an index to which it's benchmarked. For context, you'd expect to see very little or almost no tracking error coming from a pure passive portfolio. You'd see maybe 1 or 2% coming from an enhanced index fund. And then you'd see something about, you expect something about 4% for actively managed funds, at least these are the equity space. Along those lines, you'd note that tracking error is comparatively low for U.S. equities, where we're mostly in passive strategies, and a little higher in emerging markets where we have a greater active allocation. And then lastly, we show you how the individual strategies contribute to the overall portfolio risk in the rightmost column. As you recall from the last slide, 96% of the overall risk comes from equities. And here you can see how the individual equity strategies, for example, contribute to that total. Also interesting, if you look about 2/3 of the way down the page in that rightmost column, you see that our core fixed income strategy is a slight detractor from risk at negative 0.3%. And again, this is due just to the strategy's slight negative correlation to the rest portfolio. That wraps up the section for today. Happy to take any questions you may have, or we can turn the conversation over to more recent trends in the portfolio and executive.
Questions for Dan? Okay.
So now part two, forward-looking issues that the markets are facing. And then Dan is going to do some stress test analysis around the right box on here, two different scenarios on the, I always struggle what the word is. You used what, conflict? Is it a war?
I used inflation, conflict. I think I used all three.
Yeah. Anyway, next slide, please. So, the Fed rate hike, the rate hike cycle has begun. Go to the next one, please. So the important determinants for markets on a rate cycle, either up or down, is when does it start, what pace is it going to go, and where are we going to? So we're going to talk a little bit about all three of those for both the change in the policy rate and then also quantitative tightening. So the Fed has two tools in their toolkit, and they're going to use both of them. So we start with the slide here shows the Fed, the starting point of where they are. The orange dots represent the starting point where we are when they started this cycle, vis-a-vis 5 other rate cycles going back in history. And on the vertical axis, it's the deviation from the inflation target. And you can see they're further away from their inflation target now than any of the past cycles. The horizontal line is deviation from full employment. And what this slide shows is they're not quite at full employment, but 2 updates to that is one, we got the last employment number post putting this graph together. So that would shift that a little bit to the right. And then importantly, in Chair Powell's testimony a week ago Monday, he talked about the unemployment rate is one indication of employment, but another one being jobs opening versus a number of unemployed. And that's roughly 11 million unfilled jobs versus 6 million people unemployed. If you put that together with wage growth, arguably that orange dot belongs somewhere in the upper right-hand quadrant, which means the Fed has a lot of work to do. So that speaks to how much they have to do to get inflation down. Next slide, please. So the pace of rate hikes, that's an important one as well. So you can see the acceleration in the starting in the fourth quarter and then really in the first quarter on the number of rate hikes priced into the end of 22. And this speaks to the acceleration. There are 6 meetings left, and there's 8 FOMC meetings in every calendar year. We've had 2, there's 6 more left. So now the markets are pricing in 50 for the May meeting and 50 for the June meeting. So the pace is accelerating of what the front end of the bond market is pricing in. So this is meaningful as well. Next slide, please. And as to the terminal rate, the third key component. What this slide shows, again, based on the front end of the bond market, the peak in the funds rate. Again, this chart's a little bit old. The bond market has been in motion rapidly the past 2 weeks. This showed the terminal rate around 240. I think that number today is closer to 260. And then as market participants, we think based upon the starting point and how far away they are from their targets, is this adequate or is this inadequate? I think I would argue that it's inadequate given core headline inflation is 8%. Remember what their target is 2%, and that implies a rapid decline in inflation. Is it transitory? Is it supply side driven? We don't know in the future, but to me, we still haven't priced in enough in the policy rate. Next slide, please. So tool number 2, the Fed's balance sheet. So what this slide shows is the aggregate quantitative easing put in place by the major central banks over the past 12 years or so. The Fed is colored red. The black line on the top of this is the sum of all the central banks. And what this shows is the quarterly flow of quantitative easing that's taken place. So key takeaways, this magnitude of quantitative easing during the pandemic as compared to the global financial crisis, which is all the way on the left-hand side. And then those like 11 through 14, remember that was with QE2, QE3, QE4, whatever they were. And the European debt crisis going on at the same time. But just look how big this was during the pandemic. So the Fed's balance sheet swelled to almost $9 trillion. Pre-pandemic, it was 6. Pre-global financial crisis, it was less than 1. Are they going to get down to less than 1? Absolutely not. But what the Fed minutes from the last FOMC meeting were released yesterday, and some key takeaways again on start date, pace, and magnitude. They've indicated they're going to start in May. If you dissect their words. And importantly, this cycle is going to be unlike the past cycle, which was 17 and 18, and that in 17 and 18, they left the balance sheet unchanged for 3 years. Here they're leaving the balance sheet unchanged for 1 month. The pace in 17 and 18 started at 10 billion a quarter, got up to 50 billion. We expect the starting point to be larger and that to get to 100 billion a month in 3 months. And they're going to attempt to reduce the balance sheet by almost $3 trillion. That's kind of reading the tea leaves of what they said yesterday. What does this mean for markets? It means all things being equal, less demand for fixed income securities. And if you believe in the laws of supply and demand, that's lower prices, higher yields. So that's bad for your fixed income portfolio. And to the extent that that impacts other risky assets, time will tell on that. But to me, 2 important dynamics that the Fed is doing. So policy hikes and quantitative tightening. Next slide, please. So as to the impact on the equity market, the largest allocation in your portfolio. What the slide shows here is the forward PE ratio on the S&P 500 going back almost 25 years. And while you see on the right-hand side that forward PE has come down, this is as the market has come back down and earnings have remained strong. What's not concerning, or what is concerning, is that number is still higher than any time period over the past 25 years, with the exception of the NASDAQ bubble. You can kind of ignore the numbers in the box. That shows a handful of different valuation measures for the equity market, and they all show the equity market relatively overvalued, with the exception of comparing it to yields. And if you compare it to yields, the equity market has gone from undervalued to more fairly valued, but you know what's happening in yields, and that's continuing today. So this is a source of concern to the U.S. equity market, in our opinion. Next slide, please. So more concern. This shows, again, the S&P forward price earnings ratio in that, I don't know what color that is, mustard yellow. And the dotted blue line is the 10-year real yield on TIPS, so treasuries, inflation protection securities. And as a reminder, they got to about -1% real rates. And when you get to negative real rates, you get a PE multiple expansion. If you think about an equity as a series of cash flows, and if you lower that discount rate, the net present value of those cash flows is worth more. If you increase that discount rate, the net present value of those cash flows is worth less. So what's happened to that discount rate? It's going up. And what most market participants thinks are real yields have to get somewhere between 0 and 1%. And if that relationship holds, that means a PE ratio of somewhere between 14x and 18x. And as a reminder, on that last graph, we're currently around 19x. So more PE compression. Next slide, please. So these are meant to be less alarming slides. So this disaggregates the PE ratio between the 25 largest stocks and the remainder of the S&P 500. And the takeaway is the index is heavily influenced by the high market cap stocks. So think Microsoft, Apple, the Google complex, and they trade at high multiples for really good reasons. They make a lot of money. So if you look at the rest of the market in the blue line, the PE multiple is more reasonable. What is that? Somewhere around 18, maybe 17 times. So not as alarming. Next slide, please. Same theme, different expression. This slices the equity market into many different subcomponents. On the left-hand side is the S&P 500. On the right side, the NASDAQ Composite, and then some small cap and large cap in between there. The takeaway is the same in all three. The blue line represents the index. The yellow bar represents the median stock price, and the red bar, the average stock price. And what you see here is the indices are outperforming the components. Again, the large caps are holding up the indices, but there's been a lot of carnage under the surface. Particularly in the NASDAQ, the average stock is down 45% from its high. That gets lost in Microsoft being 10% off its high and Apple 7% off its high. A lot of the things have really been taken to the proverbial woodshed.
Can I add one point? This is a really important point, and it goes to why active managers have tended to underperform, because active managers equal weight their portfolios. They don't market weight the largest cap stocks. And so that's been a big contributor. It's been hard to do even as well as the benchmark unless your portfolio is concentrated in the largest tech stocks.
Next slide, please. So this is meant to show, again, some of the speculative excess that's been taken out of the market. So there's 4 different lines on here. The takeaway, they're all down 50% plus off their highs. The IPO index, the SPAC index, the renewable and clean tech index, and the fintech index. What I would add to that is the crypto complex. So the crypto complex at peak was over $3 trillion, and now it's under 2. So that's down almost 45% as well. So if you think that there was excess liquidity in the markets due to monetary policy, a lot of excess has been taken out. Enough, we'll know in the future, but a lot's come out. Next slide, please. Okay, the implications of the Russian invasion of Ukraine. I put up here a quote from Biden a couple of weeks into it. His words are there, but what he's really saying is war is inflationary. Always has been, and there's no reason to think not so in this case as well. What does this mean for markets? One could argue we've been in a deflationary environment for the past 30 to 40 years, and this is going to accelerate at least a diminishing of that deflationary environment, if not to an inflationary environment. Second key takeaway, the EU has to reduce its dependency on Russian energy. I put up their numbers here across the 3 subcomponents of energy, and it's also going to accelerate their path to renewables. But as we know, that doesn't happen overnight. So at least what Germany has publicly announced is a shift in the near term to increased usage of LNG. And it's not just energy, it's commodities as well, as Russia and Ukraine are a big supplier of a handful of different commodities, and importantly, fertilizer. And fertilizer, something like 80% of the cost of fertilizer is the cost of natural gas. And the cost of natural gas in Europe, depending upon what country, is 4 to 8 times the cost in the US. We are abundant in natural gas in this country, so our prices are relatively low. Europe is not. They're dependent upon Russia for it, and that all signs point to that changing in the future. Another important change, Germany has pledged to increase its defense spending to 2% of its GDP. And this is likely to push Germany in a forward basis away from a fiscal surplus to a fiscal deficit. And that has implications for German interest rates, which have been one of the things holding down global interest rates. And to that point, German 10-years have gone from in the pandemic to maybe -40 to something like +70 basis points. So that transition is underway as well. And a graph I didn't share on here, but I think I've shared over the past, the amount of negative yielding government debt in the world, that was peaked around 18 trillion. That's about 2 trillion now. And so that's still in Japan and a little bit in the front end of Europe, but most of that is all positive yielding now. The Russian economy, to the extent that that one cares. This was a quote from the National Deputy Security Advisor on 60 Minutes a couple of weeks ago, and an economic of this. Going back in history, the Soviet Union at its peak was something like 16% of world GDP. Soviet Union broke up, it came like high single digits. And if they're really going to be isolated in just a petro state, it's going to be, 2% of the world GDP. And then importantly, because of the ramifications on inflation, global central banks, this leads to sooner, faster, and more rate hikes, and that increases the probability of a hard landing. So let me turn it over to Dan, who's going to walk through a couple implications, a couple stress tests on your portfolios.
Thanks, Mike. And hello again, everyone. Again, as in times past, I'm sort of cribbing some research that MSCI did on behalf of their clients and exposing your portfolio to it. The research here really is attempting to frame the market's reaction function to the Russian invasion of Ukraine. You're going to see a lot of themes playing out here that Mike just discussed. There's a lot of crossing. So we know the incursion course is bad for markets. There's a lot more uncertainty regarding supply chains. There's interesting commodity shortages. There's unknown impacts to corporate earnings. So along those lines, MSCI research developed these two scenarios that can help us frame the potential impact of that invasion. Looking at the left side, or the left of the two, there's a soft landing scenario where the conflict de-escalates before the market prices in more structural changes. This is an optimistic scenario. A ceasefire and a de-escalation of the conflict would stabilize energy prices around their pre-conflict levels. Apart from a small short-term impact, there are no persistent inflationary pressures. The hit to economic growth is relatively small, and central banks stick to their plans for tightening monetary policy. The U.S. and German sovereign yield curves slightly flatten due to slower growth. Global equities decline, credit spreads widen, and then the U.S. dollar strengthens a little bit relative to the euro. And then on the right there's sort of a dimmer scenario that we've called the prolonged conflict. And again, this has longer reaching market impacts. The idea is that these sanctions impose a significant drag on growth and inflation. You see more extreme inflationary shocks. Nominal long-term rates go up as long-term inflation expectations rise, but real long-term rates drop as the economy slow down. Higher energy prices and lower business and consumer confidence, slow economic growth. So you see equities selling off more extremely, credit spreads rise, and the US dollar gains more significantly versus the euro. Given these assumptions, we can show some results on the next slide here. And again, these are the predicted returns for each of the scenarios for both the overall portfolio and selected strategies within your portfolio. Each scenario is represented by a different colored bar. Obviously, the softer landing is blue. The prolonged conflict is in red there. And the resulting predicted change in value is, of course, plotted along that horizontal axis. At the total portfolio level, you can see that the results range from a 5.3% decline under the de-escalation scenario to a 14.2% decline in the prolonged conflict scenario. You also notice that international equities sell off more extremely than the U.S., as they're expected to feel the impacts of the sanctions more deeply than our markets will. And then finally, you can see the more defensive strategies like TIPS and structured fixed income mitigating some of these losses. I'll leave you there. Glad to address any questions you may have, either now or offline.
Thank you. Questions? All right. Thank you so much.
Great. Sure thing.
So now we want to shift to executive session. So I don't know how
We're all done. Okay. All righty. Well, then here we go. Do we have a motion to move to executive session?
So moved.
Thank you, Mr. Brown. Do we have a second?
Second.
I
Want some points on the board.
All those in favor, please say aye.
Aye.
Any opposed? Any abstentions? Okay, we're moving to executive session. I think we just need, Patricia, we need like 2 minutes in between. You said, or
No,
we're good?
first we're gonna do the passport, then we'll take it.
Okay, perfect. Okay, we are moving to executive session.
no, we're going to.
Yeah, first.
Ah, we are back in public session. Hello, everyone. Susan, will you please report out?
Certainly, you can now see me. Okay, great. In executive session, We received a transition report on a completed transition within the diversified equity fund in the variable funds. We received an overview of quarterly performance at the fund level and also more detailed information on 2 specific asset classes. We laid over an issue within the private equity asset class. We received 2 presentations within the private equity asset class. Consensus was reached. We received an infrastructure presentation. Consensus was reached. We received a presentation in the emerging manager alternative credit asset class. Consensus was reached. 2 administrative matters were discussed, and a personnel matter was discussed.
Thank you, Ms. Stang. Does anyone have any further business? Okay, hearing none. Do I hear a motion to adjourn?
So moved.
Thank you, Mr. Buckley. Do I hear a second?
Second.
Thank you, Mr. Brown. All those in favor, please say aye.
Aye.
Any opposed? Any abstentions? We stand adjourned.
Aye.